Hello and welcome to the latest episode of Damien's Midweek Markets, the podcast where I tell you everything you need to know about investment markets and what is happening out there. Now, it's been an interesting week, not quite as exciting as the previous week when the Fed changed the dynamic and actually became so dovish that the market took off. But we've had some changes, we've had some positives in the market. So let us start with what's going on in America, because as I said last time, what goes on in America has a huge impact on what goes on in the rest of the world. Now, Donald Trump seems to be at the centre of most things, and we've had some slight weakening or softening in his positions to do with trade and also to do with the border wall. So we're at the point where we are fast approaching another US government shutdown. Interestingly, if you look at your stock market app, where we had a shutdown or partial shutdown of the US government just before Christmas, ironically, the market rallied after that point because it got fueled by some of the dovish comments by the Fed. But what I'm trying to show you is that just because the US government shuts down, it doesn't automatically mean that the stock market will collapse. And so what you have is this dynamic where people get worried, and the longer something lasts, the more worried they become. And actually they started to worry it was going to feed into the US GDP, the economic growth numbers, which the shutdown actually hampers because they can't report those growth numbers because the departments that actually do that have been closed. But it's open at the moment, but we could go into another partial shutdown if Donald Trump doesn't get what he wants regarding the border wall. Now, we've actually got to the part where we may be able to see the government stay open, and Trump has said he may end up agreeing to a deal. I don't know if he actually will. He's actually given himself a get-out clause. With regard to China and the US, Donald Trump has come out and said he may actually delay that 1st of March deadline. If you remember, the 1st of March deadline was the deadline where he said that there would be new tariffs imposed on Chinese imports if they didn't come up with some form of trade truce. Now, he said he's going to maybe let that slide, and it seems interesting that there's a weakening of his position in some ways, and people think that Trump may actually realise the harm he's doing to the US economy. Now, if you look at the stock market this week, so it is Wednesday today as I'm recording this, if you look at what happened yesterday, which was Tuesday, the stock market leapt about a percentage point, which is quite a bit at the moment. It's not outlandish, but in the trading range we've been in for a while, that is quite a move, and it was because Trump started to suggest that he may make some sort of concessions, and the market is desperate for any signs of positive news regarding those two factors in particular, the crisis with the US government and obviously the trade tensions. Now, the S&P 500, if you look at your stock app, you will notice that it's been bouncing along. It rallied from 2006 and went towards that moving average that I keep talking about, the 200-day moving average, and we got to a point last week where we actually hit it. So if you look at your stock market app, what we had on the S&P 500 was the market rallied strongly to 2741, which was the 200-day moving average. Now, it's almost comical when you look at it. What happened when we got towards that line? The market suddenly bounced down. It retraced back towards 2,700, and of course that 2,700 figure on the S&P 500, if you've been listening to these podcasts, has been quite key. It's been a level which we needed to get above if we're going to head towards 2,800 and possibly new highs. But once we got above it, we sort of bounced around a bit, and then we went up towards that 200-day moving average. We hit it and we retreated, and that caused a bit of alarm. We went below the 2,700 level, so you can see that on your app if you have a look, and people were worried, well, will we go lower? At the moment, there's another level of support around 2,600 and sort of 50-ish. If we're going to head lower, we need to break through that. I think if you're looking at your stock market app, and ignoring all the news out there, if the S&P 500 is above that 200-day moving average, that's very bullish. So we're above, say, 2740. It's around there at the moment. That's bullish. If we start heading below 2,700, it starts becoming negative. If we get below 2,600, that is very negative, and we could see the bottom fall out of the market. So they're key levels to watch. We could just be moving in a market that's going sideways. We do keep seeming to bounce around. And the one thing, despite all the very, very, very bullish noises out there that does make me slightly concerned. You should always look for the balanced view, is that despite the Fed being dovish, despite there being positive noises being made around the China-US trade deal, the market is still struggling to push higher. And even if we get to that 2,800 level on the S&P 500, you will see, if you go back to November and December, that they were levels where the market then reacted badly and dropped. We could have a repeat. We might not, but we've got to push a lot higher. And at the moment, the market hasn't quite got that momentum. And some of the reasons why it hasn't is if you look across the Atlantic and go into Europe, because Europe has been struggling economically. If you haven't noticed or haven't seen the news, Italy has pretty much confirmed it's in recession. The Central Bank of Europe, the ECB, has raised a bit of an alarm around the state of the European economy. All of these go into that negative economic story, the slowing global growth story that's out there. That's been actually the backdrop and the reasons why a lot of the slowdown in the stock market and the sort of froth was taken out in October. That's still there. And that's why if you look at your stock app and you go onto the 10-year yield, I remember talking to you before and saying, go and put the 10-year interest rate yield, which is denoted by TNX. That's the thing you have to put in on your stock app to try and see that yield. It dropped down. It actually rapidly dropped. And that shows a sign that the bond market is worried about economic growth, even if the stock market doesn't seem to be. And you always get this dynamic where the bond market and the equity market can tell different stories. The bond market is the most liquid market. It's the biggest market in the world. So there's a tendency that one will be proven right at some point, and often it's the bond market. So the fact that that yield is falling, really what that really means is that people are buying bonds still, and that's normally a safer bet if the economy, the global economy, is slowing. So that's something to be aware of. But in Europe, the European stock markets haven't done as well or held up as well in recent weeks as the US one. And there's an interesting dynamic, which I may have mentioned before, between the German DAX and the S&P 500 and the US stock market, is they tend to move in tandem. They've separated slightly, and therefore at some point that is likely, that correlation is going to come back together. And if it does, it's likely to mean the US stock market could fall. So we've got a lot of positives around the stock market in America. In Europe, we haven't so much because of the economic numbers. Don't forget that the Bank of England, Mark Carney, came out and raised the alarm about what was going to happen with the UK economy, possibly as a result of Brexit. So again, all these news headlines that come out about slowing profits at companies, slowing economic growth, just notice them. Don't look for them. If you start noticing there's more of them, at some point there's a possibility it could spook the market. Now, moving away from Europe, have a look at some of the emerging markets. Now, China was closed for a week because of their lunar holiday, but now it's come back, and it was interesting to see that the Chinese stock market had actually rallied in the last few days. And that again is because there were hopes about the trade truce that could happen. The market at the moment in both the Far East and in the developed world are reacting massively to headlines, so there's not actually much substance. So you've got to be prepared that they could unravel in the same way. It's not to say they will, but we're actually being moved by headlines. Now, the China and emerging markets generally have been done very well. If anybody out there follows 80/20 Investor, which is my DIY investment service, I updated my £50,000 portfolio since the last time I did this show. And one of the things that I did do was increase my exposure to emerging markets, which may sound quite bullish to people out there, because obviously emerging market assets are riskier than, say, a developed world market, so say the UK stock market or the US stock market. But emerging markets have held up very well of late, and it's not unusual for that to happen during periods of downturns in developed world markets. It's not saying it happens all the time, but it has happened on a number of occasions in the past. So that relative strength is interesting. That's not to say it always goes up. They do fall as well. But when you keep an eye on that relative strength, that momentum, you start to notice things that may be slightly uncomfortable when you invest, but you start to notice things that are doing well. And some of that is down to the strength of the dollar, the fluctuations in that, because that's a big impact on emerging markets. The other point to note is the pound, and the pound has fallen through that $1.30 level, which is quite a key support level. It's quite a sticky level, which turns into resistance once you go below it. And as I look now, we're around about 1.29, so $1.29, and that's because the Brexit headlines have become more and more negative. So keep an eye on that on your stock app. You can see where we are. Like most people, you've probably started to tune out from Brexit and what's going on, but that gives you a quick snapshot, and there is a weight of a downward pressure that's re-emerging onto the pound versus the dollar. It suddenly became very bullish. It leapt above that 200-day moving average of its own about 2 weeks ago, on signs that Brexit could be delayed or stopped altogether. But now it's gone the other way, so there's a downward pressure. So if you're investing, what you will notice is that if the pound keeps falling, then your overseas assets will rise in value just because of the currency exchange, ignoring what the actual asset does itself. But what you will also see is the FTSE will gain some support. But if it reverses and the pound suddenly strengthens, then you'll see the FTSE actually probably fall and your overseas assets drop in value slightly. One thing to note is some people have asked, where could the pound go as a result of Brexit? We're only a month or so away. Now, I have not got a crystal ball, but I've heard a range of predictions that we could go down to way below $1.20 to 1.15 and go up as high as 1.45 if Brexit actually is concluded positively or stopped altogether. So we'd go down the low end, obviously, if we had a hard Brexit. That's a massive swing, and so betting either way is going to be very difficult, because if you get it wrong, you can wipe out years and years of returns for your portfolios. So I would suggest that you don't try and bet on it. One thing I want to just close on that's been interesting. Some people have asked what I follow on my stock app, and over time I'll reveal some of them. But there are one or two. For example, Boeing, the Boeing company. So if you search for BA in the index, that is the share price of Boeing. Now, Boeing actually have a huge exposure to China because of the parts they make for planes, etc. And what that is a really good quasi-indicator of how well the China-US trade deal is going, or the trade negotiations, I should say. When they seem positive, the share price goes up. When they are looking like there's going to be something negative, the share price falls. So keep an eye on that share price. Over time, I will talk about others that I have. Oil, I've been mentioning oil recently. The oil price and shares are still correlated, and that correlation seems to have increased again. And there's a lot of times where we've seen news. What you have, if you watch something like Bloomberg, which a lot of people call bubble TV, you'll see loads of headlines trying to explain away the world. And I know this podcast does elements of that as well. But the day-to-day moves, the hour-by-hour moves that they try to explain, are sometimes they're creating narratives that don't really exist. But more confusingly, the narratives from one day will be completely different to the next. They will have changed full circle. And sometimes it can boil down to just something simple like a correlation between two assets. And the oil price has been one of those. And the price of a barrel of oil is reflective of fears over global growth. And so keep an eye on that. And on your stock app, it's the one that is the index that's titled CL equals F. And in the last week, that took a nasty dive. And the stock market took a dive as well. And then it rebounded. So, and that was again partly because the oil price rebounded. So one closing thought I want to say, we look very bullish. We've gone back above that 200-day moving average, just about. The US stock market, as I look, hasn't opened yet on Wednesday, so I don't know what it's going to do. But if we suddenly pull back from there, don't be surprised if you start hearing words like double top. And what that means is, if you think of a W, that shape, an inverted W, that can be a sign where you hit a line and you bounce back down and then go back up and hit it again, that you've tested that and you can't break through it. You'll see that start to be bounded around probably, which can be a bearish signal that stocks could go lower. But like all these things, you only know in hindsight. So that's it for this week. If you want to get in touch, then do so at Damien@moneytothemasses.com. You can contact me via Twitter at moneytothemasses with the number 2, and of course via Instagram at Money to the Masses. So please send in any suggestions or topics or questions you've got, and I will try and cover them next week.